Yeah, so there's the new handout. I'll go over it later what the new part is. But anyway, we'll go ahead and get started. It's so nice out. You may be the class, so
It's okay.
we're not going to wait around. All right. So going through, this will be like the new handout page 2, problem number 1. Now, in this one, we don't have any permanent or temporary differences, but I just want to talk a little bit about what these are and how they come about, just as kind of a background information. Permanent differences are things that are never going to be allowed by the IRS. So the first one are life insurance premiums. So permanent difference is life insurance premium and actually life insurance payouts. Life insurance, when it gets paid out, also those payouts are generally not taxed, at least up to the point of what was put into them. So life insurance premiums are never allowed to be expensed for taxes. And there's a good reason why. It's because unlike something like fire insurance, if you have fire insurance, you can write it off on your taxes. If you have life insurance, you can't, because no one lives forever. So life insurance is looked at as an investment. You can't invest money in the bank and then write that off. And that's kind of the way the IRS looks at it. Say, look, people don't live forever. And it's not unusual to have a company that will have key person insurance. You have somebody who's, well, I think of like Famous Amos, the guy that made the cookies. The Famous Amos company probably had a life insurance policy on Famous Amos because that was, a big part of the marketing and all that. So it's not unusual to have those things, but the IRS says, no, those aren't really insurance. It's 100% those are going to get paid out because no one's going to live forever. So life insurance is one of those things that they don't allow. Fire insurance, that's fine, but life insurance, no. So and they never will allow those to be written up. Another thing on there that I can just talk about right now is fines. If you get fined, let's say you get fined by the EPA. Now, for regular GAAP accounting, you have to have an expense for that or a loss for that. We got fined by the EPA, we had to show that we lost that money. The IRS takes a different view of it. The IRS says, no, expenses and loss reduces your taxable income. We don't allow you to get a tax benefit from breaking the law. So if you get a fine or a penalty, you cannot write that off on your taxes. You're not going to get a tax benefit to, breaking the EPA law or whatever, whatever thing it is. So life insurance policies and fines and penalties are what they call permanent differences. The IRS will never let you write those things off. So those two are very commonly put into the permanent differences. Now, the other ones here, these are common ones that are temporary differences. So these are permanent differences. They'll never change. These are ones that are simply timing differences. Last class, we went through the kind of a long thing to do with the deferred tax liability thing up here. But these are differences that are simply timing differences. For instance, the depreciation. They allow you to depreciate more early on, and that's because they want to encourage you to buy equipment, but later on, it'll reverse back out. Rent collected in advance. Rent collected in advance. This is, for us, this would be unearned revenue for for the gap accounting. So gap accounting, we call that unearned revenue. The IRS takes a different view of it. When you collect rent in advance, the IRS says, look, you got the cash, you can pay the taxes on it. So whether you earn it or not, they don't really care. If you collected the rent in advance, then you pay taxes. Again, for gap, it's unearned revenue. And the same thing is true for warranty expense. Excuse me. You guys remember warranty expense? You estimate what the warranty is going to be for the next 3 years, and you put that estimated expense on your financial statements. The IRS says, no, you can't estimate the expense, only the actual expense. So how much did you actually pay for these warranty? And again, if it's got a 3-year warranty, you say, well, wait, there's still 2 more years on this warranty, or 3 or whatever. They say, whatever you pay out, that is your expense. It's got to be the cash payments out, not some estimated number. So again, these are all timing differences. The depreciation, it's a timing difference. The rent collected in advance. When you collect it in advance, they say you got the cash, you can pay the taxes on it. The next year, when you earn it, you didn't collect it that year. They don't tax you on it. They don't tax you on it twice. You've already paid taxes on it. And by the way, that'll become more like a what they call a tax asset, because that is something that's paid in advance. You actually pay the taxes on it before you could recognize it. We'll talk about that later. But anyway, and then the warranty expense. We have to estimate it for our gap financial statements. It's got a 3-year warranty. We estimate what that warranty is. The IRS says, no. Whatever cash you pay out, that's what you can write off. Only the actual numbers, not an estimated number. The IRS is obviously does not like estimated numbers. Those are frowned upon. Okay, so anyway, this first problem here is pretty straightforward. We have the pre-tax financial income is 100,000. Income tax rate is 32%. And so what we're going to do is we're going to stop at a couple places here. So this will be the tax expense. That's not how you spell expense. Income. We'll add up all these. Now these are, this is gonna look stupid, but I don't care. Hey, I'm not proud. So there isn't anything else. So the taxable, the tax expense income will be 100,000. Oops. Tax rate is 32%. It says 32,000. So this will be our tax expense income. And underneath this one, we'll have our taxes payable income. Probably by the way, put it be taxes. Yeah, I like taxes payable because I'll show you why in a second. Those are the actual accounts. Now, again, in this one, let me get rid of this. Same thing. All right, times 32%. So you look at this and you say, well, that looks pretty simple. It's not too crazy. Yeah, way too many. I think I used to put the calculations down here. Okay, anyway, so our tax expense is 32,000. Delete some of these. And our taxes payable liability going up is 32,000. So it kind of looks like this. What's a good way to do this? Oh, I know. I'm gonna move this one out. Yeah, maybe not that. Okay, so this is what this kind of looks like. Oh, I just did something stupid. How do we get that back? Oh, okay. Okay, so here we go. Okay, so that one's pretty straightforward. And then again, there's nothing crazy about it. The expense equals the payable, and that's just it. Okay. So we're going to do the same thing coming down here. I'm just going to copy this because I'm lazy. Now, here we run into these permanent differences. So we have these life insurance premiums. The IRS will never let us write those off. So there isn't anything getting reversed out for those. So we're just going to have to add that back into our income. So we subtracted this at some point, these life insurance premiums for GAAP. We subtracted those. But when it comes to our taxes, the government says, no, 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 that is an investment. That is not an actual insurance. So you cannot write that off. We add those together, 221, 700, I think. So this, we're going to multiply by our tax rate of 25%. Oops. equals some wacky number. $55,455. So this is what our tax bill is going to be. And again, we had to add those life insurance premiums back in because the IRS says no one lives forever. And because of that, you're going to 100% sure you're going to collect that. That is not really insurance. It is an investment. Okay, so taxes payable income will be the same. And so we'll have the same journal entry with different numbers. By the way, we do have there's a new chapter 18 handout. If you're using the old one, that's fine too. But when we get to it's actually the last problem on this thing. It's going to be a new one, a different one. If you look at the old one, it's got something from, I don't know, 10 years ago or something on it. It was a cut and paste error on my part. But anyway, so this is all of them will be okay up until the very last one if you're using the old one. All right, so this is our tax expense and our tax payable. So far it's pretty straightforward. Okay, down here, number 3 is when we get into the first ones where we have temporary differences. Okay, we don't have any permanent differences. So this will be 150,000. The tax rate is 30%. What is that? 3 times 45,000. May want to check that just to make sure. Taxes payable income, also taxable income is another way of saying it. Now, notice something here though. We are going to be allowed to take excess depreciation. So this is depreciation that's more than we're taking for GAAP. So this is $10,000 more than GAAP we can depreciate. What's that going to do to our income?
Gonna reduce it.
Yep. So our taxable income will be, instead of 150,000, it'll be 140,000. So this will be a negative. Our taxable income, instead of being 150,000, is 140,000. Times that 42,000 is 42,000. Hey, I didn't keep my festive coloring. Now, this is a temporary difference. At some point, it's going to reverse out. So we got out of paying the taxes on 10,000 of our income, basically. But we're going to have to pay that back in the future. So what we're going to do is we're going to multiply this by 0.30. So this would be 3,000. All right, so coming down here, tax expense is 45,000. I should probably write that in, right? I'm gonna do it the way they usually show it. Taxes payable, this is a liability. Went up 42,000. And we got a brand new account called deferred tax liability. The risk of sounding stupid, this is a liability. And it's going up. Okay, so we draw in my tremendously helpful arrows. Now, this deferred tax liability is obviously going to be long-term because this is not going to be paid off in the next year. If it's going to be paid off in the next year, it'd be a payable. But this is going to be paid off sometime in the future, so there's going to be a long-term liability of 3,000. So at some point in the future, this is going to reverse out. Where's on that? All right. Well, let's go to the next one here. All right, this one we have well, we have both. We have both kinds of differences. All right, so. Our tax expense income will be. $430,000. And again, the IRS is not letting us write off these fines and penalties. They said, no, 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 you're supposed to be being punished. We're not going to give you a tax break for breaking the law. $2,000. All right, so this is our expense. And again, this fines and penalties, that'll never reverse out. We're never going to be allowed to write that off for taxes. Second here. Okay. So this will be down here, this will be taxes payable income. Or taxable income. I like saying taxes payable because that's really what it boils down to. That's the income that your payable is going to come off of. Hey, oopsie daisy. Let's try that again. Okay, so this 40,000, this is going to be subtracted. So our taxes payable income will be what, 390? Hold on. 56. And this is going to be a temporary difference. $16,000. Okay. That's not how you spell expense. That's how you spell expense. So tax expense, 172,000. Deferred tax liability. Which, I don't know if I even have to put this in, but it's a liability. That liability, it's a liability. Write that down, everybody. All right, and then taxes payable. So here's our tax expense. We're paying taxes on what? Basically the true amount that we owe for our income. And then we're saying, okay, now, we're going to pay 156,000 of it in this year, but in the future, we're going to pay the rest of the money we owe on this income because this is a temporary difference. So, we're going to have to pay both of these. It's just that 16,000 is in the future. And at some point, it's gonna reverse out. Okay. Now, coming down here, this is a little bit different one. Any questions on these? If it doesn't make sense, make sure you stop. I'll just keep talking, you don't get it. So, yeah, if it doesn't make sense, stop me and we can go over any of it, actually. Now, this one is gonna be a little bit different. We don't have any permanent differences. Okay, so tax expense. $1,000 times 34%. Is that right? 27,200. Let me try that again. It is right, 27,200. Okay. Okay, now this down here, rent collected in advance. So we cannot pick that up as revenue for GAAP purposes. But the IRS takes a different view of it. The IRS says you got the cash. You can pay the taxes on it. So is this going to add to our income or subtract from it for tax purposes?
Add to it.
Add to it. Good. So we're going to be taxes on 100,000. This is 34,000. Okay, now, this rent collected in advance. If you think about it, one more maybe. So we're paying taxes on this 20,000 that we're not recognizing as revenue. So we're paying this in advance. It's sort of like a prepaid asset, like we're paying it ahead of time, right? So this is going to be, instead of being a deferred tax liability, this is going to be a deferred tax asset because it's sort of like a prepaid. We've already paid for the income in advance. So this one is going to be a deferred tax asset. What is it, 3,400? No, 6,800. So basically, of these three, it kind of looks like this. This one will subtract from our income, this one will add to it. And the unpaid warranty expenses will subtract from it. Add to it. Okay. So let's take a look at the journal entries here. So we will have tax expense. We will have a deferred tax asset. Which is an asset. Yep. Of 6,800. This is sort of like a prepaid. Oops. Sort of like a prepaid. So let me draw in my incredibly helpful arrows. Just ignore those if they make it more confusing, but yeah, so the only one that's going to decrease it for these is going to be this excess depreciation. Everything else will add to it, will be a deferred tax asset. Okay. No, wait a minute. Okay. So coming down here. Tax expense income is 285,000. Tax rate 35%. And again, life insurance premiums, they have no sense of humor for those. So they make you add that back on your book. That's an expense that they don't allow. 103,250. Okay, coming down here, unpaid warranty expense. So we have to estimate our warranty expense. The IRS does not like estimates. So when we do our, our gap warranty expense, we're told we have to estimate it, have a reasonable, estimate of it for the next, however long the warranty is for. So if it's a 3-year warranty on the stuff you're selling, you have to estimate what that is and expense it in the year of the sale. So you take all 3 years and expense it in the year of the sale. And again, that's a matching rule. You match your revenues with the expenses. Now, the IRS does not like estimates. So if you estimate, you owe for 500,000, but you only pay out 80,000, they say, no, you only paid out 80,000. You can't write off 500,000. 80,000 is what you paid out, 80,000 is what you get to write off. So, but this is a temporary difference. If your estimate is reasonable, it should come out to be something close to it. So this is going to, the unpaid warranty expenses, are they going to add to the taxable income, the tax payable income, or is that again to subtract from it?
Add.
And yeah, so that's a new word I just made up. The other people just give you the same old words. I make up new words because okay, plus 35,000. 330. $115,000. Okay, so this is our payable now. The 35,000. %35 equals okay. 12,250. Okay, so and for warranty expense, we're going to have a deferred tax asset. Surprisingly, is an asset. 12,250. And then we're going to have our tax payable. $15,500. Ooh. You guys saw that. I think my electricity might be going out. Let's hope that doesn't happen. Okay. So deferred tax asset. Okay, let's get rid of this. Okay. 7 and 8. Okay, let's see what this one looks like. So this one. Tax expense income is 403,000. Total 3 times 30% is 120,900. And by the way, so this is truly the expense that we have on our income based on the code. The overall, this is, these are permanent differences, so those are not going to change. So this is really on our income based on the tax code. This is what we're going to be paying. This down here, these cause timing differences. Okay, so we'll have our okay, so let's take a look at this. So this the excess depreciation will decrease our income. This will add it. So we'll come up with some number. $365. $109,500. Okay, now let's see. The excess depreciation. Is this going to cause a deferred tax asset or deferred tax liability? $15,900.
It'd be a liability.
Yep. And this one will be 23 equal 4,500. And so this one will be a deferred tax asset, right? We're paying, so this one we're paying ahead of time. That's like a prepaid. This one we're not paying off, so we're gonna owe 50,900 in the future because that excess depreciation is gonna run out. Okay, so let's take a look at this. Oh wait, let's Let me get my color coding. Okay. We do that every single time. Some kind of timing difference. Okay, so 120, 900. We will have our tax asset is 4,500. It's sort of like we paid in advance on that 15,000. Okay, tax liability is going up by 15,300. And our taxes payable. It looks like a mess. All right, what you know what I'm gonna do on this. Whenever you run into kind of a complex problem like this, it's a good idea just to add up your debits and credits just to make sure that they balance. So I'm just gonna add up both sides here. All right. So this totals 125. Oops, oops, oops. 24, 4. Yeah, they do that. Okay. Yeah, just it's I don't know. It's a good idea to make sure. Make sure that it's still okay. Let's go ahead and take a break. We'll come back and okay, yeah, take a break. So let's say be back at 7:06. I'm going to talk a little bit about taxes for just a moment, and that is that uh, if you if you're undecided about your career, taxes isn't a bad way to go. The people look when it comes to accounting, basically, if you talk about pure accounting, not consulting, but just accounting, you basically have three choices really that are the major fields, and that's going to be doing accounting, like you learn through here, auditing, or taxes. And of those three, the ones that companies are going to tell you is the most valuable is going to be the taxes. Being in the accounting department or even being an auditor, a lot of times they kind of look at you as if you're overhead. You know, we want our financial statements to be, to be correct or whatever, but we want to do it with as few as people as possible. Yeah, and same thing with auditing. It's especially like the external auditors that come in. It's an expense, you got to pay it. Your company really doesn't get a lot out of it. They're required to get it usually. And it's just looked at as an expense. Tax people are oftentimes looked at quite differently. These are people that are going to save us money. This is, every dollar we put into this tax department, we get back more than that. It's kind of looked almost as like a profit center. So if you're thinking about getting into a career, I would say, one of the most secure careers in accounting you can go into is taxes. There's people always want tax people. And nowadays they're even paying bonuses and things like that to get them. So if you are undecided and you I don't know if any of you guys are doing the VITA program with Dr. Knudsen, but the VITA program is Volunteer Income Tax Assistant, and that's a really good program. But anyway, it's a good career to go into taxes. And again, it's the one career in accounting that they kind of look at differently than, like I say, the accounting and auditing. Not that they don't look at those in a certain way, but they generally don't think they're going to make money on it. Internal auditing is a little bit, yeah. They they're looked on. It's just looked on different. Just looked on different. Now, I did internal auditing, and we did save the company money overall. But even that, it's just the sense that whenever you showed up, they really didn't look at you the same way as they look at people who are in taxes. And people who are in taxes are saving us money, whereas sometimes auditing and oftentimes accounting, they don't look at you the same way. So anyway, it's just a suggestion that it may not be a bad idea to look into if you're interested in doing taxes. Okay, we'll do one more of these, and then we'll go on to some of the more wacky things. By the way, the stuff we're doing right now, this would be done by the tax department. The tax department will figure all this stuff out. And if you're in accounting, you'll just wait for them to give you the numbers. At least if it's a large company, anyways, that's what you're going to do. Again, this taxes payable income is was commonly referred to as taxable income. Right. So these two, this one's going to be a tax liability. This one will be a tax asset. This one's kind of like a prepaid. The spacing is off here. What's that sizes or something? How come that's okay? It doesn't matter. 6,000. So I'm gonna add what size up. What is that? 38,400. 38,400. Okay. All right, difference between financial accounting and tax depreciation. This is a kind of a kind of it is a demonstration, kind of what we did before. I think there's a problem in the book like this. All right, so we're gonna find the difference between our financial depreciation and our tax depreciation. So this will be our financial, this will be our tax depreciation. Okay, so we have equipment cost 90,000. Have a 6-year life. So, oops, that's not right. 90,000 minus the residual value, which is 0, divided by 6 years equals 15,000. Yeah, $15,000 per year. Okay. So this is gonna be our depreciation per year for financial depreciation. So I'm just gonna come down here and put that in. So that's our financial depreciation. Now, this is the modified accelerated cost recovery system. Just to let you know, when I was going through it, it was called acres. Now it's called makers, but it was called acres because it was accelerated cost recovery system. But then they modified it, so now it's a modified accelerated cost recovery system. And I think I told you guys this. I'm not going to do it, but I mean I can do it, but I'm not going to do it. The this is based on the double declining balance method with 0 residual value, with what they call a half-year convention. So a 5-year life item will actually go over 6 years. It'll take half of it in the first year, and then half of it in the last year. And I think it's on year 4 that it switches over to straight line, which is part of the method. I'll show you. I'll show you how you got year 1, and then we'll just leave it at that. %100 times 1/5 equals 40%. Oops, I'm sorry, times 2. Equals 40%. So this is double decline balance method, 40%. And then they say, okay, well, in the first year, you buy some things in January, you buy some things in February, blah, 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 that on average, you buy about halfway through the year. So if you multiply this by 0.5, oops, halfway through the year, you'll end up with 20%. So that's where that first 20% comes from. And then we just simply follow the method. We decline the balance. So this would be 100 minus 20 would be 80% times 1/5 times 2, blah, blah, blah. Okay, so what we're going to do is multiply each of these by our 90,000. Let me change this back into plain old black and white so it's not confusing. Okay. And you'll notice this 596 is half of that. It's a half-year convention at the end. I'm gonna add these up just because I want to make sure this comes out to 90,000. Hey, it does. Okay. So this is the IRS depreciation. All right, excess depreciation will just be the difference between those two. So first year is 3,000. Second year is 15,800. Third year is 2,280. Fourth year is And these should total out to 0. And so this kind of shows you the temporary difference here. You guys haven't been hearing me the whole time. I'm
Nope.
sorry. I'm sorry. Let me know if it. Okay. You know what? I get all these notifications on the screen, and I usually get a notification. They can't hear you. You're muted. When I start talking, it'll pop up, and it didn't pop up. So I apologize. Okay. I'm not sure how far back that went, but well, it was probably good. It's probably good for everybody, right?
It was just for then.
Okay. All right. Well, so net operating loss to carry the operating loss and then carry forward.
Is that Professor, can you hear me?
Yeah.
Is that that 52, it's just 52,000?
I don't know. I didn't write the whole thing. Yeah, so this one, yeah, this 52,000, this is because we have more deferred tax liabilities than we do deferred tax assets in the non-current. So you're going to net those.
Okay.
Same thing up here. And the whole point is that the current ones you net and the non-current ones, the long-term ones, you net those also. And by the way, that's one of the reasons why we do this. You know, someone says, well, can't you just net those and say, you know, you have a deferred tax asset, deferred tax liability. Can't you just net those and say, okay, it's a deferred tax liability of what, 4,000? The
Yeah.
reason you can't do that, well, let's look at this one. The reason you can't do that is this excess depreciation is probably long-term. This rent collected in advance is probably short-term. You know, this is probably current, and this is probably long-term. So these are actually in two different places, you know, on the balance sheet. So one would be long-term, one would be short-term. So that's why we don't net them. We wait until the end and we see, okay, which ones, you know, of all the deferred assets and deferred liabilities, which ones are current and which ones are non-current or long-term. So we always put them in separately for whatever the you know, the items are. And that's why we do it, because of this. You know, the ones that are current, we'll keep those together. Oops. And the ones that are non-current or long-term. I was wondering why they did that, by the way. You know, that became popular, like, I don't know, 15, 20 years ago. They used to always say long-term, now they say non-current. I'm not sure why, but really it doesn't matter. Yeah, so we keep them separated because, you know, some of them might be long-term, some of them might be short-term.
Okay, thanks.
You know, okay. So net operating loss carry forward. This got confusing because they used to have carry. If you have the old handout, it's going to say talk about carry back. They eliminated the carry back years ago. They reinstated it for 2018, 2019, and 2020. It used to be carry back 2 years. For those, it was carry back 5 years. 2021 and 2022, you can't carry back anymore. So now it all goes carry forward. One of the things about accounting for taxes is that because things change all the time, you know, it isn't like GAAP accounting. You know, if it's a revenue this year, it's a revenue next year. You know, it's the same. They change the rules and they do it for different reasons. But anyway, so as of 2021, and now we're in 2022, doing the taxes for 2022, you cannot go backwards. You can only go forwards with the net operating loss. And the idea is people would pay in taxes. They'd have all these years where they're profitable. They'd pay in taxes. They have a net operating loss where they don't pay in taxes. But they say, well, wait a minute. You know, in a business, your income goes up and down. And when it goes down, we should be able to get a benefit for that. And you used to be able to go back to your previous taxes and get a refund basically from your previous taxes, 2 years to 5 years, depending on what year we did this in. But not as we, you have to go into the forward into the future. And they used to have a time limit of 20 years going into the future. And now it's indefinite. You can go into the future forever. So if you have a lot of losses, you can go, you may not be paying taxes for years. People always are making fun of Donald Trump that, he didn't pay any taxes. He probably has a bunch of net operating losses. The real estate industry went through a really bad time, like in the 2008, 2009, whatever. There's probably a ton of losses there. So any income he does make, it probably is bumping up against that. Now, I worked at 2 companies that went through really hard times, US Steel and Navistar. They both were virtually bankrupt for a while. And we carried those net operating losses. We had such huge losses. We actually ran into the 20-year limit that they used to have. That we couldn't, in 20 years, we couldn't make up for the losses we had. So we actually lost those because of the 20-year limit on it. They don't have that anymore. Now it's indefinite. But anyway, so if you have net operating loss, you can claim that against your income. It was a weird time going through business then. But going into the future, you can take it off of your income. And the idea is that income goes up and down, and they can't just tax you in the good years and then there's kind of an averaging thing that goes. Okay. All right, so we have a net operating loss of 400,000 in 2023. And again, if you don't have this on your number 11, pull up the new handout. It should be on there. And don't worry, you can turn in both handouts. If you already worked on the other one, don't redo both of them or whatever. Just turn in both of them. I'll figure it out. Okay. So in 2023, we had net operating loss of 400,000. Now the enacted rate was 25% in 2023. All the future years have an enacted rate of 30%. Okay, so the question is, what do we do with this? What we'll do with this is we'll pick it up as a deferred tax asset. And we're going to do it at the rate that we are going to reverse this out at. And this will be sort of like a gain. It'll be called the benefit. By the way, net operating loss, you also often I see that just abbreviated as NOL. I do. So now this is actually a gain. So this is a benefit. This is a gain, basically. So you'll show on your financial statements, you'll show a $400,000 loss. Oops, let's put another 0 on that. And then you'll basically reduce that loss by 120,000. because you picked up this asset for 120,000. So this would be 400,000, 280, something like that. Would be on shown. That'd be shown on your GAAP financial statements. And again, this is sort of like a gain. And so this would be shown as a gain. It'd be shown 400,000, negative 400,000, positive 120. You reduce your loss by 120,000. So it'd be, I think it'd be operating loss is 280. But by the way, just in case you're wondering, taxes have a way of smoothing income because if you have a lot of income, it gets reduced, right? You pay taxes on it. If you have a loss, that loss is reduced because it ends up being a benefit going into the future. So your gains are not so high and your losses are not so high. It kind of smooth. It has a tendency to smooth the income a little bit more. Okay, now we have the 80% rule. You're probably saying, what is that? Well, it's a rule that, like the carryback, comes and goes, but the 80% rule. It used to be that you could, if you had income, you could match it 100% with this these losses up here. It used to be 100%. Now they say you can only do 80%. So it'll look like this. 80% times 150, 150,000. Means that we can avoid taxes on $120,000 of that. So we'll have taxable income going into 2024 of 30,000. Okay, I'm going to multiply each of these by the tax rate of 30%, and I'll show you why in a second. I'm going to run out of, I don't know why, I think I made this thing too wide. I should. Okay. So 30% of 150,000 is 45,000. $36,000. Okay. So this is what this would look like. Do the journal entry for this one. Tax expense, we would take pay the tax expense on the entire income that we have, which is 45,000. Our deferred tax asset, we have in the books at 120,000. This is an unhappy coincidence. I'm going to change this next time I do it. But we have 120,000 deferred tax asset. Well, we're using up some of that deferred tax asset. How much are we using up? We're using up 36,000 of it. So this is going to be an asset going down. And this will be our taxes payable. Oops. Oops. So this is that 80% rule. Let's put a positive spin on it. Let's say the beloved 80% tax rule. It used to be 100%. It used to be if you had 150,000, you would take your net operating loss of 150,000 and your taxable income would be 0. Now they're not so generous. They say, well, they're not so generous in one way. They say you take 80% of it, but they also say that you're not going to lose these ever. You know, the net operating loss. And again, people say, does that ever happen? Yeah, happened twice. I know of. 2 companies I work for. Okay. So let's do the same thing down here. So net operating loss allowed 80%. Okay, so we would have depreciation, not depreciation, I'm sorry. Tax expense. Hey, I spelled expense right. Oops, didn't do it. I celebrated too early there. We're going to use up some more of our deferred tax assets. And we owe taxes of both those. Okay, so there's actually 2 different things going on here now. And this goes by the difference between tax accounting and GAAP accounting. For taxes, they keep track of the total amount of the loss. For GAAP, we keep track of the asset. You know, we're keeping track of this 120,000. This is what we have in the books. So there's 120,000 benefit we have, we have that on the books, and so we keep track of it. So how much the net operating loss is left? It looked like this. Started out with 400,000. We used up 120,000 in 2024. We used up 60,000 here. What am I doing? Mark's doing stupid things. Let's try that again. 120,000 we used up in the 2024. We used up another 160,000 of it in 2025. Whatever that equals. Oh man, 120,000 left. That's like a triple unhappy coincidence. These 120,000s, these are not related. It's an incredibly bad coincidence. I'm gonna go buy a lottery ticket. Anyway, how much is left of it? 120,000. And this handout's gonna get revised again tonight. So this is how much of that is left. Yeah, I'm gonna get a little more space here. Okay, how much of the deferred taxes is left? Okay, well, the deferred taxes, we started out with 120,000. Man. Not related to the 120,000 above here. Not related to either of these two. We used up 36 of it in 48. Luckily, this will not come out to one. So we still have of this asset left. $36,000. That's because it's based on 120,000, so that 36,000 is per. Okay. You know, why couldn't I pick 500? All right. So this would be 36,000 less. The IRS, they keep track of the loss. They how much of the loss is left. So this is what's left of your net operating loss. This is what's left of the deferred asset. This is for GAAP. So this is what will be on your books as a deferred tax asset. Kind of like back here. You know, the deferred tax asset, this is what will be on your books. At 36,000. Probably as a long term. Any question on that? You guys gonna get the test? You say, what's the answer? It's got to be 120,000. The answer is also 120,000. Everything one. All right. So let's. Well, you can turn that in. I guess. Do I have a drop for it? Check and make sure that. See if I have a drop for that. I think I do. Yep. So chapter 18 handout. So we're going to continue with this now. Don't forget. There is the chapter 16 exam. Some of you have already turned it in, I know. But the chapter 16 exam is due this Friday. So we won't do anything else with chapter 18, but make sure you get the chapter 16 in if you examine it, if you haven't already. Any questions? And we'll continue this next week with chapter 18. No? All right. Go and enjoy the beautiful weather. See you next week.
Have a good night, Professor.
Like,
Good night.